I want to provide a brief overview of mutual funds. And in subsequent videos, I'll go into a little bit more detail about mutual funds. But here I want to introduce the concept. Now, what mutual funds do is they pool the funds of investors and use those funds to purchase a portfolio of assets. And there's a lot of advantages to that. First, the investor gets professional management. Okay, small-time investors who don't have the time to study stocks or bonds or other types of assets may want professional management. And if you're a small investor, you may not have the resources to hire someone to do this for you. You can do this through a mutual fund. And many mutual funds have very small minimums to open the fund. Some have as $3,000 or $5,000, but some have as little as $50 as long as you agree to allow them to take out $50 or $100 a month out of your checking account. So for people who are just getting started in investing, this can be a great way to start. Another advantage of mutual funds is portfolio diversification. That is the idea of buying a lot of different securities. Again, for the small investor, for the person who only has a few $1,000s to invest, it's going to be impossible to buy enough different types of assets to reduce the risk of an adverse shock to one sector of the economy. Okay, for example, the banking sector might be badly hit, and if all you owned was bank stocks, you'd be in real trouble. But if you hold a portfolio that has some bank stocks and some manufacturing companies and some technology companies, then you get this diversification. So if one sector goes down, you don't lose all of your money. You get the advantage of investing small amounts of money. I mentioned that before. You don't have to have 100,000 or 200,000 or a million to invest. You can invest for a few $1,000s, and as I said before, some mutual funds will allow you to start with $50 as long as you make a small contribution every month that's automatically taken out of your account. They also provide certain services such as record keeping. When it comes tax time, they will let you know what's been distributed so that you can fill out your tax return. They'll reinvest the dividends for you if that's what you want. You may be able to, depending on what you're doing, if you have enough accumulated and you want money sent to your account, you can have money automatically sent to your account. You can have money automatically sent from your account to your mutual fund account so that you are increasing the amount of shares you own. Or you can have it the other way where they're selling shares for you and putting it into your checking account so you can live off of that money. Now, there are several ways that mutual funds can be organized. The one that most of us think of as a mutual fund is actually an open-end investment company. In this case, investors buy and sell shares directly with the mutual fund company without a secondary market. So you can buy your shares directly from a company like Vanguard or Fidelity. Now, you may use a broker, but there's no secondary market. You don't go to the New York Stock Exchange or the NASDAQ to buy these. And they have an unlimited number of shares. Shares are created when someone purchases shares, and they're reduced when someone sells those shares. So the number of shares keeps changing. Purchase and selling price is determined by something referred to as the net asset value. And net asset value is the value of all the securities minus the liabilities of the total shares outstanding. And then you'll divide it by the total number of shares. So you'll get net asset value per share, and that's the price you're going to pay. All purchases and sales are completed at the end of the day after the stock markets have closed. So if you want to purchase shares in some mutual fund, some open-end company, and you do it at 2 o'clock in the afternoon, the price you're going to get is going to be whatever the close price is at the end of the day. A second way that mutual funds are set up, and this is less commonly known, okay, unless you're a little more sophisticated in finance, something called a closed-end investment company. Now here, they only sell at the initial offering. The shares are created at the initial offering. And so when you're buying shares in a closed-end fund, it's like buying shares of a stock on a stock exchange. If you buy shares of IBM stock, IBM doesn't create shares for you. You simply go to your brokerage account, whether it's an online account or you can call up your broker, and they will find someone who has shares who wants to sell those shares. So no shares are created, simply the person who owns it changes. So there's a person who owns them, they sell them to you, they don't own them anymore, now you own them. So in this case, they have a limited number of shares, and the number of shares does not change. What's good about this type of mutual fund or this closed-end investment company is that the investment advisor doesn't have to worry about cash inflow or outflows. Now, if you're familiar with mutual funds, sometimes mutual funds will actually close their doors. Open-end funds will close their doors to new investors because they've just grown so large and the investment advisor can't find anything good to invest in. So in order to maintain their loyalty or their obligation to current shareholders, they simply won't accept any more money because it can be difficult. It's nice that your fund is so popular, that it's doing so well, that everybody wants to buy shares of your fund, but it can be difficult for that fund manager to find something to invest in. So they may close the door to new investment. This isn't the case here because the investment advisor doesn't exchange shares. So when shares change hands, they just change hands from one person who owned it to another person, But they are not. There's no extra money coming into the fund for the advisor to invest. Purchase and selling price is determined by supply and demand, the same way it is for regular stock. If Microsoft stock goes up in price, it's because people are buying it. If it's going down in price, it's because people don't want to buy it and they're selling it. And these funds will generally sell at a premium or a discount, and it's usually a discount, to the net asset value. In fact, there are people who consider this to be a really great investment strategy. Buy closed-end funds that are selling at a discount. Okay, the third way that funds can be set up is something it's relatively new, and they're referred to as exchange-traded funds, or ETFs. And these are a basket of securities designed to track a specific market index. So they're similar to index mutual funds. I haven't talked about that. I'll do a separate video on the different types of funds. But an index fund, rather than hire a fund manager to pick different stocks, they simply try and match the performance of some index like the S&P 500 or the Wilshire 5000. And in fact, they may buy all the stocks that are actually in that index. Okay, sometimes they buy less than that. They use some statistical analysis, and they find they only need to buy 300 of the 500 stocks in the S&P 500, and it matches, the returns 99%, and it's less expensive for them to do it that way. But basically, they try and track some market index. In this case, when you buy an exchange-traded fund, the name is exactly what it is. It's traded on an exchange. So it trades like an individual stock on an exchange, on some stock exchange. And you can buy and sell ETFs any time of the day. So if you happen to be sitting at your computer and some particularly bad news comes out in the, the bad news seems to cause the market to fall quite a bit, you can buy the ETF at that point in time at the lower price. Okay, and should it rebound during the rest of the day, you've purchased it at a lower price. Remember, with an open-end fund, you're buying it at the end of the day's close price. So if the fund fell $2 a share, let's say, and then it bounced back $2 by the close of business, then you would get the same price. Okay, you wouldn't get that lower price. You'd get whatever the close price is at the end of the day for an open-end fund. But for an exchange-traded fund, you would get whatever the price was at the time you purchased it. These tend to have low management expenses due to the limit to trading by the investment advisor. So there's nothing for this person to trade. The basket of securities is already there. Now you are going to have some commissions. Okay, you have to go through your brokerage account and you have to buy these exchange traded funds. Okay, there's low turnover, which helps avoid taxes. If a mutual fund manager were to sell securities in the portfolio and realize some gains, then if you happen to have that open-end mutual fund and the fund manager has done that, you're going to have a tax liability. Okay, at the end of the year, they will send you your tax statement, and you'll find out that, oh, the fund had, you have $3,000 in capital gains, and you have to pay tax on that. In the case of the ETF, if you don't sell the ETF, then you're not going to incur that capital gain. Okay, some of the types of ETFs, they get these nice names here, diamonds. Okay, they track the Dow Jones Industrial Average. Spiders track the S&P 500. Cubes track the NASDAQ 100, etc. So those are the three basic ways that mutual funds are set up. And in future videos, I'll talk about some other details, things like expenses and the types of different funds that there are.